Silver has a wall, a resistance wall at 29.5. If it's able to pierce and break through that wall, it goes to.
Welcome to Silver Heist. Thank you to our returning subscribers and guests. We are a channel that likes to hold physical gold and silver. To support my creation, please subscribe. All right, well, welcome everybody. Ben Franklin once said, an investment in knowledge pays the best interest. So I'm open and excited to learn more when given the chance. So today I've got a guest, Mr. Lior Gantz, and he's the CEO of the Wealth Research Group. So we've got some questions for him to learn from his experience with regard to gold, silver, the stock market, inflation, and more. So Mr. Gantz, thank you for joining us today. Welcome to the show.
Thank you for having me.
Great. So gold approached its all-time high recently. Where do you see gold going this calendar year?
I think that gold has historically proven that on rate hike cycles, it moves up, it appreciates. Since 1971, we've had 6 rate hike eras. Twice in the 70s, we've had another one in the 90s. We've had in the 2000s, we had the 2015 to 2018 one. And now we have a 7th one. In all previous 6, so that's 6 out of 6 times, gold has appreciated, with the average being 30%. If we go to March 15th, just a couple of weeks ago, gold trading at about 1920 when the first rate hike was announced, you're talking about a 30% move from there on average. That's $570. It takes us to just over 2,500. I do want to also point out that we have sort of a time span for this, so it's even better. We know that the market is pricing in between 7 and 9 rate hikes this year, and that it's pricing in a rate cut by the end of 2023 because the markets really feel like we have an inflationary burst that must be contained immediately, but that long term, we don't have a 1970 style inflation. We have an inflation that's caused by what has happened in the last 2 years with supply chains and with zero COVID policies, opening and closing, et cetera, making a lot of disruptions. So that's one thing. Secondly, April 1st, so this is exactly 3 years ago, April 1st, 2019, the Bank of International Settlements changes gold from tier 3 to tier 1. Basically, it indirectly says, hey, whatever the price is today, April 1st, 2019, we believe gold is worth double. It was worth $12.91 on that day. So effectively, the Central Bank of Central Bank believes that it's worth $2,582. So both of these, both the rate hike cycles historically and the Bank of International Settlements are both pointing towards the 2,500 range. So I like that. And I also like that because I think that a mature bull market for gold implies a 50 to 55 to 1 with silver. And I think that silver deserves to trade anywhere between 45 and 50 once this is over.
So what do you think it will take to fix inflation? Is the Fed approaching it the right way?
There's 2 economies. There's the real economy and there's the financial economy. The financial economy, it moves when the Fed signals and telegraphs stuff in advance. It's just pricing in everything. The more knowledge it has, it starts to price things in. I'll give you an example. The Fed, November 4th, Powell says transitory is no longer valid. We should not think of inflation as transitory. The market peaked on that day, that very day. They raised interest rates March 15th. This is what, November, December, 4.5 months, but it priced it in 4.5 months before. So it moves on words, which means to me that because the markets are pricing in 7 rate hikes this year, the market is effectively already priced that much in. Same with gold, right? Okay, it did not price in a Russian invasion, so we saw a lot of problems with that. So that's the Wall Street economy or the financial economy. The everyday person and the Main Street economy, or the real economy, it doesn't move that way. Now that the rate hikes are coming, it's going to impact housing because mortgages are going to get more expensive. We have not seen that yet. It's not like a person looking to get a mortgage. The average person is sitting there and dissecting what Powell's saying before buying a house, but it is getting a call from its mortgage broker and telling him, hey, rate hikes are coming now, and da-da-da. So I think the real economy, or the rate sensitive parts of the economy, which are borrowing and housing, are going to get affected throughout the rest of 2022.
So with respect to the stock market, do you think inflation and the future already priced in, or do you see room for a correction?
I think the world we live in and the economy we live in on Wall Street is always pricing in about 80% of something. So what that means is, to a large degree, someone like me, for example, right? I have a portfolio. Powell's already told me, hey, I'm going to raise rates by 7 times this year. If I wanted to sell anything, I had already done it. But does it not mean that if he actually does raise rates 7 times, does it not mean that I'll change my mind? Well, that's debatable, right? I can change my mind. So what I'm saying is 80% is priced in. And if Powell all of a sudden in May raises rates by 50 basis points, which doesn't change anything, it could be that it's still 7 rate hikes, but I don't like the pace, then maybe I sell in accordance to that. Now, personally, I don't do that. The Fed doesn't change my mind in terms of what I need to own, because the kind of stocks that I own in my portfolio, their management teams, will do well at 2% inflation, 3% inflation, 8%. They'll get through it because that's what I invest in. You're betting that the companies you own or that you own a part of know how to deal with it better. If Powell does something that is out of what Wall Street thinks, stuff can still happen. But remember what's already priced in. We already had a nuclear threat. We already had a Russian. We already had a variant in January of this year that took about 12 to 15% of the global workforce and told it to stay home. We already had 41-year high inflation plus inflation expectations. So a lot has already been discussed and talked about. Therefore, I feel like we might have already seen the lows for this year, save for another major scenario that I don't know yet.
Can you help differentiate between being in cash versus having some cash ready to be deployed when the timing is right?
Great question. So unless you're like a year from retirement or 2, 3, 4 years from retirement, if you have a runway like myself, I'm 37, I'm going to be 38 in July. Cash should be the least of your agendas, of your priorities. The markets in general, the free enterprise system, America, grows 75% of the trading days it appreciates. So in other words, the S&P 500, 3 out of 4 days goes up historically. You're missing out on owning a piece of the greatest economic machine the world has ever known. With all the criticism, and Americans are, very critique of their government, of this, of that. At the end of the day, there is no machine on this planet that is as reliable and as profitable as corporate America. It's full of problems. I can spend 25 years talking to you about all of the problems that corporate America has. At the end of the day, it works despite everything. So I think you should be involved in equities for appreciation and in real estate for income and leverage and taxation benefits, and to a lesser degree in everything else that you feel like is important. Cash should be a strategic tool you use, whereby if you, let's say you're on a salary and every month you put a little bit more into the markets, well, if the markets are frothy, you should put less. If the markets are panicked, you should put more. That's how you should look at your cash. It's a temporary parking place before you buy that asset. Or in an analogy, it's a short-term layover before you get to your final destination. if you have cash obligations that you know about and that are calculated, let's say you want to pay for your children's college fund or whatever. Okay, well, you put that aside, and in that savings bracket, that should be cash that you don't flip in and out of the markets. So when you talk about a cash position to me is everything that I'm saving and not looking to invest at all. I'm just looking to save. Then I have this strategic cash, which is just a layover, where I say, look, the markets have not seen a correction in 2 years. I should hold a little bit more cash. That's what I mean by that. With that savings bracket of cash, what I did personally is I said, look, first thing I want to do is I want to take 2 years worth of my living expenses. I want to basically calculate how much my family burns on a single month. I'll multiply that by 24, so 2 years, and I'll convert that fiat currency, that savings power, into physical gold and silver. Whatever I have on top of that, I can do some fiat currencies and that just for convenience and whatnot. So that's how I treated that. If there's a depression or a recession that goes on for 2 years, I have 2 years worth of my living expenses today at boom times in gold and silver. And since then, I've already increased that to being 5% of my net worth. And that's how I look at cash versus strategic cash. It's two types of cash for me.
You touched on it a little bit, but what's your outlook for silver this calendar year?
Look, you're asking me about a calendar year, but I answered that for gold because we have a plan with the rate hikes. So it's easier for me to give you an outlook. But even when you ask me that, I don't think 2,500 comes in 2022. I think 2,500 comes in this rate hike cycle. I think silver, it performs well, but not as well as gold over time. During the fiat monetary system in the last 51 years, gold is compounded at around 6.8%, whereas silver is about 3.4%, just half. But it catches periods where it is able to outperform massively. In those periods, I think it's worthwhile either using leverage, silver miners, or options to take advantage of how quickly silver moves, and with such a high likelihood. And here's the example I can give you. Silver has a wall, a resistance wall at 29.5. If it's able to pierce and break through that wall, it goes to 36 in a matter of 3, 4, 5 weeks. So it makes a 25% move or 30% move in no time. So my way of doing it is I don't want to speculate on whether or not it happens. But once it happens, because the technical patterns show an 85% probability that if it breaks through 29.5, it goes to 36 with an 85% probability, then it pays to look into either the miners, who are going to do way more than 30% on that kind of move, options, which are riskier, but with an 85% probability, you're lowering your risk, or some sort of a leverage vehicle like a XX or XXX ETF. And that's because it's a very special situation. But in general, I think that silver has a place between 25 and 30 an ounce in the world we live in before it breaks through that resistance. I don't see a lot of downside for it. I don't see a lot of upside. I think it traded in a range because there's a massive short position on it, and a very concentrated one, and almost a constant one, which makes it very difficult for silver to trade freely. If it were trading freely, it'd probably be over 40 an ounce already.
Where do you see investment sentiment for the mining industry, and what signs would you look for to see that it's getting more positive?
I see it right now very stale. Nothing exciting. I don't see retail participating. I hardly see institutional participating. And here's what needs to happen. First of all, gold needs to go above 2,000 an ounce and stay there. If it stays there, then it's going to bring in a lot of institutional money, because at 2000 and higher, if Wall Street starts to believe that that's the right price for gold long term, 2000 and higher, well, then around the world, the median AZAC, which is the all-in sustaining cost to mine gold, is $975. At 2000 or higher, you're literally printing money. It's 100% profit margins to produce gold. We really need gold at 2000 and higher for a lengthy time to convince Wall Street that that's the right price. Then you need the Newmonts, the Barricks, the Rio Tintos, the big ones to start paying good dividends, good steady dividends, and for the CEOs of those companies to say these are very reliable dividends. That's going to bring in more institutional. That's for the large caps or the mid caps. The small caps, the one that can move 500%, 1,000%, 2,000%, 10,000% in a matter of a year. So not a decade, but a year. What those need is mergers and acquisitions. We need to see 2 or 3 or 4 of these smaller type companies, the 50 to 150 to 200 million market cap, getting bought out by bigger companies for double what they currently are in the market. So for large premiums. Why? Because then somebody like myself will say, okay, well, what just happened here? A company in jurisdiction A just got bought out by this company, and it had this much in gold reserves, this much in silver reserves, this much spent on it. Here are the metrics that this large company liked about this particular company. Who has similar grade, scope, size, and in the same jurisdiction or similar? I can start to speculate on which other companies are going to get bought out, because I can see which companies the big ones like. And then there's a frenzy to find that next one. Because if you know that you have a chance to make 100% like that overnight, then people take the risk. And that's what we need. We need mergers and acquisitions. Now, I don't think we're there yet, but I do see, in terms of valuations and how attractive the mining industry is, you're fine buying and waiting, because you're buying them so cheap. You're buying these miners really, really cheap. And when I say miners, I just mean companies in the mining sector, but not specifically operational miners.
So if the audience wants to plug into a report or a newsletter, where can they go?
Best way is to go to our website. When you go to wealthresearchgroup.com, on the homepage is where you can sign up for the free newsletter. That's literally the best way to know what's going on right now with everything that I'm doing. So I speak with hedge fund managers, CEOs, economists, etc. I boil it down to 3 articles a week. They get sent to your inbox. That's the best way. There's a report we created called wealthresearchgroup.com/gold playbook. It's the most comprehensive by far manual online for this mining industry, mining stocks in general, all the different categories. If you go there and download that, you'll see it's the most comprehensive online guide for this sector out there that I've seen.
Mr. Gantz, thank you for your time. Thanks for joining us today.
Thank you for having me.